Welcome to this Financial Fitness Worldwide webinar. Today we have the great privilege to invite back Peter Armitage, who's been with us before. Many of you will recognize him. For those of you that don't know, Peter started in this industry in 1994. A very interesting year for South Africa. And he's been worked with Merrill Lynch, Deutsche Bank, Nedbank, and Investec, and was the record top-rated fund manager with the Financial Mail 21 times over his career with those financial institutions. So in 2012, Peter decided to launch Anchor Capital. And starting from a small company with great ambitions, it has now grown into a leading figure in the financial services sector here and the investment world in South Africa, and has recently reached a milestone of 250 billion rand in client assets under management, and with 25,000 clients. So a remarkable set of achievements over this period of Peter's career. So welcome, Peter.
Thank you very much, Jim. And you talk about the Financial Mail. I don't know if you saw yesterday the news that the Financial Mail will have its last edition in October. The times certainly change.
Yeah, print media is not surviving. Do they intend to stay in business on a web version?
No, I think they're going to channel it all into the Business Day. So Business Day online. So they're keeping with one title. Obviously, in the print version, you could have a different newspaper and magazine, but they're trying to get all the users into one place.
Right. Well, times keep changing, Peter, and it's your job as CEO and joint CIO of Anchor Capital to try and stay a little bit ahead of it.
Absolutely.
So never-ending challenge. And Peter, one of the tools that you've put together to manage this challenge has been the Anchor Navigator, which you publish quarterly, and we at Financial Fitness have found it very useful as a guideline to where the markets might be going in the future. Would you like to start telling us a little bit about how Anchor got to 250 billion in effectively 12 years, and then how you decided to move into producing this Navigator guidance?
Yeah, certainly, Jim. I think we started off with the belief that we could do something different and bespoke for individuals, and we've always been very much investment as opposed to sales driven, and we've got an investment team of about 30 people sitting back at the office, looking at shares, equities, bonds, funds, economies, currencies, etc. And that feeds into a process which we've just gradually added on clients as we've moved through. I think part of our growth has been, we've got a minority investment in Financial Fitness. So every year or 2 years, I always say when we partner with people, we want to increase the quality of our business and not decrease it. And we certainly did that with Financial Fitness. So finding good quality people that we can work together on. I think we found some nice synergies there. So the business today, half of the growth has come from acquisition. In October last year, we bought Credo, which is a 25-year-old UK business. They've got about 110 of that 275 billion. And we've just been focused on providing service and great returns to clients. I think this slide really is the nub of what you correctly called the Navigator. So every quarter, obviously, things change every day. So every day our team is meeting and assessing whether there's major changes or the like. But I think one of the things we learn over time is fiddling and trying to time when to get in and out of markets and make smaller marginal changes. Typically tends to increase cost and not increase the returns of a client. So while we have those regular meetings on a quarterly basis, we put together what we call the Navigator, where we put a huge amount of effort, bring into a room all of our 30 guys in the business and compare all the different asset classes with each other and try and form a 12-month view. We update that every quarter. We don't change it drastically, but it's what's pretty important. It's all very well to talk about equities or talk about bonds or talk about property, but it's not just how they look; it's how they look to others. So this is where we stand at the moment from an asset allocation.
Shall we start at the top then, Peter, with the domestic position? I see you're neutral on most asset classes except for alternatives. Do you want to talk us quickly through that neutral and positive stance on the domestic side?
Yeah, so to talk through local assets, I think to remember that we've had a pretty decent return out of South African equities over the course of the last year. And in fact, the SA market has matched the S&P over the last 3 years. It's kind of been quite fortuitous because it's been different factors driving it. So whereas about a year ago, it was the government of national unity, interest rates coming down and the like, what we've had more recently is the big impact on local markets has come from gold and PGM shares. So we think those are pretty foolish. The local economy ain't looking that great. But there's still quite a nice mix of assets. So we've downgraded to neutral. So we would still own local equities, but they're kind of getting to fairly fully priced. I think you'd need to see some quite big interest rate cuts, and there could be some coming as early as this week to see that kicking up. Then the bond market as well, you've had a pretty decent performance. So the neutral is more a reflection of what's happened in the market. So bonds have had a pretty strong, you're already in double-digit returns for the year to date. And bonds have come down and the rand has strengthened. The two are quite closely linked, largely because of global factors. The dollar's weakened, money's gone into emerging markets. There's been different parts of the world where money can be made. And as money has flowed into emerging markets, we become a natural beneficiary. If you picture people run global emerging market funds, people put money into those as a default. They put a portion of that into the South African market. So the running yield on our bond fund is sitting at about just over 9%. So we think you can get a little bit more capital appreciation and kind of that 10% return. Remembering, of course, inflation in South Africa is only sitting at 3 or 4%. So that's, there's some pretty decent returns in prospect, even though, they might not be the 20% of the last few months. And then the last category is alternatives, where, that's private debt, it's private equity. You don't really have the same valuation issues and that's really the unlisted market. So we've got funds and baskets of assets that are achieving that kind of 10 to 15% category. So that's how we'd see the domestic market, John.
Right. And then global, the standout is equity and alternatives.
Yeah. So again, the world is sitting with interest rates having peaked, and we'll show you a chart coming up. Interest rates are on their way down, and as interest rates come down, you can get a little bit of profit on top of your yield in things like bonds. So a 6% return in US government bonds, but a little bit more than that in equities. And we'll show you over a few slides to come. Equities are getting pretty expensive, Jim, and I think one has to approach it with caution. I think if the fundamentals and the growth prospects for US equities look pretty good, but the valuations are pretty steep. So the 8% is positive, but it's kind of the lower end of positive. That's what you should expect to get in equities over time. There were times, if you look back over the course of the last year or two, there have been times when the projection has been 15% plus.
Right.
And cash is coming right down. It's sitting at 4%. But the reason we have negative, the interest rates are coming down in America. So in Europe, you're in 2% in your cash. In America, you're in 4% in your cash. And if you want to put your money in a bank in Switzerland, you earn -2%. That's because everybody's been looking for a place to move their dollars, and the Swiss do not want your money. If you give
Yeah.
them 100 euros, they're going to give you 98 back in a year's time. And then
Yeah.
alternatives again, it's kind of always in that 8 to 12% space because that's what return the assets get. And you're not sensitive to high valuations or low valuations.
Right. Well, Peter, you've mentioned that you've got some reasons for these points of view. Do you want to take us through those?
Yeah, so very simply, and they're quite big picture graphs.
Mm.
The world has been an incredibly tumultuous place this year, certainly if you look at all the Bloomberg headlines. And we've had a number of times during the year when our clients phone us and say, shouldn't I just be bailing out of all risk assets? Risk assets, of course, mean anything that's listed that can go down in price, like equities. But in fact, the global GDP growth outlook for 2026 and 27 actually looks pretty healthy. 2025 is a bit slower, and that's largely driven by Donald Trump, uncertainty around the world, a weaker dollar, companies being hesitant to invest in higher. But we've kind of seen that wave coming through. It hasn't been as hectic as what people expected. And importantly, so if you go to this slide, this is the growth in
Mm.
America. So earnings growth on average is about 8 to 9% per dollar in dollars per annum. It was pretty low in 2023. 2025, the year we're in now, is looking around 11%, but then some pretty strong growth for the next 2 years. Remembering that the US market is about 60 to 65% of global, the market capitalization of shares around the world. And that's driven by interest rates coming down. It's driven by a weaker dollar. Obviously, an American company that's earning euros, when they convert it back into dollars, it's now more dollars than it was before. And then you've got this absolutely, once in a lifetime capex investment cycle that's happening in artificial intelligence, where there's hundreds of billions of dollars being invested in infrastructure in order to service the AI world. So next year, the projected spend on AI is about $500 billion, Jim. And that's roughly the
Yeah.
same size as the South African economy. So the South African economy being invested in 1 year in that capex. And then
Yeah.
the last,
No matter what we think about the United States, they keep driving the world forward with their innovation.
Yeah, absolutely. And if you look at that AI spend, about 55% of it happening in the US, probably 25 in China, and the rest spread between Japan and the rest. So with the outlook looking pretty positive, shares are pretty expensive. And that's why, on that sheet, we had the 8% return as opposed to at times like these, you would say, surely you'd get 15% out of the stock market. But when things look good, as you'd expect, they're pretty expensive. You don't get a cheap Ferrari. So one's got to be, it doesn't mean you can't get returns when shares are expensive. They can, the earnings growth can be strong and they can stay expensive for a while. But we certainly are investing with caution. There's certain shares you take off the table. And also you position yourself slightly differently in the equity market. So there's been, the valuations are much lower in Europe and Japan and other parts of the world. Emerging markets are looking a lot more interesting. So people who've made massive amounts of money in the US market have been looking around the rest of the world. And in fact, you've had, much better performance from European markets than US markets, if you look over the course of certainly the year to date.
And that's something that we would tend to forget sometimes, Peter, that there are some very interesting companies in Europe and obviously Asia, but they've been very much in the shadows of the USA for a long time. So yeah, what they call in this industry rotation is starting to happen.
Yeah, and I think it's a bit of push and pull, Jim. So you've had in America things look pretty rosy for the next few years. What Trump is doing from a tariff perspective and forcing fixed investment into America is pretty positive. But things have got pretty expensive. and you are starting to see a bit of a wobble now in terms of jobs numbers in America. So they're going to start having to pull interest rates down to keep the economy going. And Trump has also scared people off. I think the pools of money around the world are going, hold on, particularly with the big spend that Trump is undertaking. The balance sheet is a problem, as it is for many developed countries, and they're taking the view that they need to grow out of that. So they're going on a spending spree as opposed to pulling back, which is putting some pressure on, if you look at long-term bond yields. In other words, if you're lending money to Donald Trump for 30 years, the rates are actually quite high. So you're having to be compensated for the risk you're taking. So people have said, well, where else in the world can we invest? And the sleeping giants, like the European banks, which have been sitting at 8 or 9% dividend yields for years, suddenly have got picked up, and people have gone, hold on, that's a hell of a lot more attractive, and it's half the price as the American banks. Another big driver has been the defense industry, obviously, with the European countries pushing from 1 to 1.5% GDP on defense, moving up to 4 or 5. So there's a whole industry that's been revived. And then in emerging markets, there's, I think people are paying attention to something like China again. So it was interesting when the whole AR boom happened in America, the Chinese AR shares did nothing. And suddenly they're realizing the inventiveness. And if you look at what China's been able to achieve in other industries, they're saying, hold on, there's also some action in China. So shares like Alibaba, Baidu, been kicking up strongly recently. So and also, if you measure your portfolio in dollars, the currency can have something of an impact. So we've actually seen better performance outside of America than America over the course of the last year.
Yeah. So your next slide, Peter, was continuing to sort of build your case on that rationale. So where are we here with these are some of the guys that work for you?
Yeah, these are some of my employees. You might recognize some of them. These are all CEOs of the really big companies in America, as well as, for a bit of South African flavor, I've put Johan Rupert in the bottom right-hand corner. I was going to put 2 South African golfers after Trump's last meeting, because they seem to have an interest into South African economics. But I think, this is half jokingly, but the beauty of equities and investment is, as fund managers, we can hire these guys and have them working for us when we think they're doing a good job, and without going to the CCMA or going through 6 months of firing procedures. Once we think they're not doing a good job, we can fire them, and that's the beauty of having investment capital and the ability to invest in it. So this focuses on where the returns have come from. And, it's a big table. If you focus on the top left, what I've circled there, so developed markets have given 11.6% to the end of August in dollars. So already a pretty good return for the year. But you can see if you go up and down that column, some of the European countries and tech has done even better than that. If you go across to the sectors in America, you can see some really nice performance, the tech type stuff. And South Africa is sitting at 13.7% in US dollars for the year. So, most countries and most asset classes have done pretty well. When the one caveat to that is the rand has obviously strengthened now by about 8% for the year. So if you could have been in global markets, but if you're converting it back into rands, that's a little bit low. But obviously, your global investments you should view in dollars.
Well, it works for us and against us. So we have to live with these swings in currency values. So there's a little bit more on currencies, Peter.
Yeah. So if you look at where you are in investment markets now, and you look back to January, if I told you in January what was going to happen in terms of tariffs, in terms of wars, Donald Trump, the fear factors, the geopolitics, you'd be very surprised to see the market up as it has been. But we've kind of explained that the earnings growth still looks pretty decent. because a lot of the actions that have been taken are positive for US companies. But what has been left behind, and the two things that are very different to the beginning of the year, is the US dollar and the gold price. So what this table on the left-hand side here shows you is the dollar against the average of all other currencies is down about 10% for the year, which is pretty dramatic, and it's part of Trump's plan. He wants tariffs to protect American manufacture, but a weaker dollar achieves the same thing because imports become a lot more expensive and their exports are cheaper for the rest of the world. So particularly against the pound and the euro. And in fact, the first 6 months of the year has been the weakest the dollar has been against the euro for 50 years. And part of that, as we explained earlier, has been people's anxiety about the way that they're going about driving. So the economy is going to do pretty well in the short term, but it's a concern about the longer term. And he's obviously alienating a lot of investors around the world. If you go to the right-hand side there, you can see the emerging market currencies have been pretty strong. So the rand strengthened by 7% against the US dollar over the course of the year, and pretty much everything.
Peter, it seems counterintuitive that the Russian ruble should be appreciated by 39% year to date.
Yeah, I think you need to view that in the context. If you go along that line, you can see over 3 years, it's weakened by 26%. So it took a massive dive, and that's just a bit of a recovery. It's not actually a sign of fundamentals.
Right.
So, yeah, and then the gold price, people have been looking, tied into the dollar, people have been looking for places to invest the money that they had in dollars. It's gone into the euro, it's gone into the Swiss franc. As we said, the Swiss don't want your money, so they're giving you negative interest rates. But it's also found its way into gold. And gold, on an inflation-adjusted basis, is close to an all-time high. And that's people are saying, okay, I can be comfortable in this physical substance which doesn't have all of the ramifications and risks of currencies.
Here we have interest rates.
Yeah, so this is the world, the price of money. So interest rates, what you pay to borrow, what you get when you lend. This is kind of the guiding factor and the starting point around the world is the cost of money in America. And you can see that went down to naught after COVID. So that pulling out all the stops, basically making money free. And that's what created all the inflation around the world. Because obviously, if you can borrow money for free, you'll go and spend money and it creates artificial demand. They then had massive interest rate hikes. If you look from 2022 to try and contain that inflation. So you can see from this, they created it, then they tried to contain it. And now so to give you a picture, sorry, carry on, Jim.
Yeah, and we all wish that they had done it in a much more smooth way, perhaps over 2 years between 2021 and 22, instead of just hiking so much in 22.
Yeah, so this is, when we talk about the risks and the valuations being high, when you get such radical moves, you get unintended consequence. And we don't necessarily have a crystal ball. And this is what can create imbalances in markets. So this chart here, we're sitting now at about 4.25. An equilibrium rate, which is neither stimulatory or pulling the economy back, is around the 3.5% rate. So you might well see an interest rate drop this week from the Fed and see that coming down a little bit further.
Right.
And then, as I was saying earlier, Jim, the actual performance of companies, despite everything that's happened, is pretty strong. So this is the earnings growth of American companies in the second quarter of 2025. And you can see in the yellow block that we've circled on the right-hand side, earnings growth coming in at 12%. And that's across most sectors, with big communication services, IT, financials, those have been the big drivers there.
Yeah. Continuing to perform as they have been for a long time.
Yeah, and then Jim, this is just the what Donald Trump calls his one big beautiful bill. And I
Gary.
only learned a month or two ago that's actually the name of it. It's not a nickname, that's what it's
Yeah.
called. And what's been passed through the American politics. The key thing to
Mhm.
look at here, this red graph on the left-hand side, that's the deficit. Obviously massive in 2020 as the stimulus came through, but they're just going into more and more deficit and creating more and more debt in America. And you can see on the right-hand side there, the things that are increasing spend and decreasing spend. But if you go right down to the bottom, it's a deficit of $4 trillion, which is something that our kids are going to have to pay for. And then this is just my last picture, Jim, to try and, it rolls easily off the lips to talk about this big capex and infrastructure spend in America on AI, just to try and provide a picture of what this means. So this was a piece of land 4 years ago, and this is new
Mm.
capex, which is data centers with computers and chips in. This is Project Stargate, one of the parts of it, which is $100 billion project. Over time, OpenAI, Microsoft, and Oracle all invested in it. And this all needs energy, needs infrastructure, needs building, needs spend, need banks to finance it. And this is what's being created in order to service the insatiable AI demand. That's really only in its early days. So
Yes,
that,
Peter, it's amazing what they keep doing in the United States. They keep reinventing themselves and rebuilding industries. And, as you say, that you can hire and fire these captains of industry if you don't want them in your portfolio. Um, Donald Trump recently came out and said that he would like to stop the quarterly reporting on the S&P companies, listed companies. Um, that keeps a lot of pressure on short-termism in the United States. Um, do you think that it would be better if they were a little bit longer term in their reporting requirements or their planning requirements?
yeah, I mean, I do actually think that, I mean, I'm all for transparency, but you must remember in Europe and in South Africa, it's every 6 months,
Mm.
and a lot of countries around the world. And having been run a listed business, we listed our business and delisted it in 2020. A 3 month period is such a small window. And you see results come out and share prices move 20% on a day about, somebody missing their target over a very short time period. Also, I mean, it typically takes 2 months or more to get your results together. So you're reporting results, and the next quarter's often kind of almost already started.
Yeah.
So a lot of people would have a big issue with it, but I think practically it does make quite a bit of sense.
Well, Peter, I think you've summarized the current situation extremely well. Would you like to perhaps round it off by a final comment to our viewers in terms
Yeah,
of?
I think just to put this last slide up again, I
Mhm.
think I think there's still pretty decent returns in prospect across most asset classes. One thing we didn't talk about was too much was the rand. Obviously at 17.35, the rand will weaken over time. That's one thing we got certainty over. So it's probably a good time to have a little bit more international exposure. So markets are surprisingly buoyant and assets look surprisingly strong based on what's happened out there. But everything that's happened, ironically, has not resulted in, it's resulted in the outlook for America actually looking a bit better. For the time being, people have looked outside of America because things are pretty expensive. And there's been some nice assets to invest in other countries. But it's the key is remain diversified. Make sure you've got enough equity exposure. Don't be too scared of a bit of volatility. It's the equities that give the good returns over time. But I think returns have been good for the last year or two. And I think investors will still make a lot of money over the next 3 to 5 years.
Right. Well, thank you, Peter. We're pretty much out of time now. So just to finish off by thanking you for summarizing that so well, and just to letting our clients know that, you know, we at Financial Fitness now have access to this amazing research that happens in Anchor on a ongoing basis. And it's very useful for us to receive those navigator reports on a quarterly basis, even though those are just to give opinions, not summarizing a whole company in a quarter. So thank you, Peter. Thank you for your time today with us.
Thanks, Jim, and good luck out there.
And thank you for watching, everyone out there. And you know, we will look forward to the next time when we come and talk on this worldwide webinar. So I hope you enjoyed it. Please place your comments and give us feedback. We love to hear from you. So thank you very much and goodbye.